Well, good afternoon, everyone, and welcome to the CFA Institute Research Challenge for Colorado and Wyoming. This is the seventh annual CFA Institute Research Challenge in Colorado. And my name is Ivan. I'm going to be your MC for tonight. And we have Marshall Isik, who is also one of the coordinators. And Marshall will be keeping track of time. And Marshall, we can show you 1 minute warning sign. So the team that will be presenting, they will see 1 minute yellow sign once you have 1 minute remaining. And then once time is up, Marshall will also tell you time is up and you have to finish the sentence that you have started, and that's it. And we have Oksana Donchila. She will be joining later. She's our media and PR coordinator. So I would like to say thank you to the team of DaVita for their support and participation in this year research challenge. The team at DaVita has hosted the corporate presentation a couple of months ago. They also were very generous to answer all the students' questions, and each team had an opportunity to submit a follow-up questions to the management of DaVita. And here we have Angela Gray, who's actually going to be one of the judges. He's a group finance director at DaVita. We had Patrick McKinnon, vice president at DaVita, who was involved at the beginning of the competition. Jim Gustafson, vice president of finance at DaVita, he gave the presentation to students a couple of months ago. Borka Bofarul, he's also been very involved and helped to communicate and get together like all the people at DaVita. And I would like also to say thank you to the rest of the team at DaVita for their support and for answering questions and for their time. Thank you. This year we'll have 6 university teams participating in the research challenge. The winner of the local final will advance to the regional and hopefully to the global final. And during all the competitions from now on, they will be presenting the case on DaVita healthcare. So they will still be doing the same presentation from today all the way to the Americas and hopefully to the global final. The Americas final will be on April 12th, and the global final will be on April 14th in Chicago. This is the event format for tonight. Next, I'll introduce the judges. Then we'll do a review of the rules. Then the teams will give presentations. And then after all the 6 teams are done presenting, we'll have intermission and judges will deliberate. Then we'll take the group photographs and overall group photographs of all the teams. Then we'll give certificates and we will have trophies for the winning team. And then the reception will follow for the next couple of hours after we announce the winning team. So please stick around and network. You might you might come and go as the time allows you. And I would like to say a few words about the CFA Institute Research Challenge and about the CFA Institute. For those of you who don't know, the CFA Institute Research Challenge is the global competition which tests analytics, valuation, report writing, and presentation skills of university students. Last year, for example, there were over 3,500 students from over 775 universities globally participating. From the last 10 years of existence of the Research Challenge, there were more than 10,000 students that went through the same program as we did. CFA Institute is the global association of investment professionals that sets the standard for professional excellence and credentials. The organization is champion for ethical behavior in investment markets and a respected source of knowledge in the global financial communities. So the end goal of the CFA Institute is to create the environment where investors' interests come first, markets function in their best, and economies grow. CFA Institute has more than 100 13,000 members in 140 countries, and there are over 102,000 CFA charter holders. The local CFA Institute Research Challenge is hosted by the CFA Society of Colorado, and we are also one of the largest CFA societies in America. We have over 1,100 members. And this is our 7th year of organizing the local research challenge. And I would like to congratulate all 6 teams tonight. You have done extraordinarily hard work of preparing the research and working on the equity research for the last 5 months. And I think on this note, I would like to introduce today's judges. We have a panel of 4 judges today. First, I will introduce Angela Gray. He is the Group Finance Director at DaVita. Prior to DaVita, Mr. Gray was Vice President and Investment Banking Division of Healthcare at Goldman Sachs. Previously to that position, he was a Mechanical Design Engineer at Philips Medical Systems. Mr. Gray graduated from Columbia Business University with MBA in Finance. The next judge on the list, I have Peter Quinn, CFA. Peter, raise your hand. Peter is the Principal and Chief Investment Officer at Helm Investment Management, where he's responsible for all aspects of the firm's management. Prior to this position, he worked as Senior Equity Analyst at Copious Wealth, where he co-managed the internal equity portfolio. Previous to that position, he worked as Fixed Income Analyst at Great West Life. Mr. Quinn began his professional career in investment banking in New York City. Mr. Quinn is past president of CFA Society Colorado. Mr. Quinn graduated from Cornell University with Bachelor of Arts in English with distinction. The next judge we have is Matt Solmer, CFA. Matt is Vice President and leads the Defined Contribution and Wealth Advisor Services team at Janus. Prior to joining Janus, Mr. Sommer spent 17 years at Morgan Stanley Wealth Management and its predecessors. He held a number of senior management positions, including Director of Financial Planning at Citi Global Wealth Management and Director of Retirement Planning at Smith Barney. Mr. Sommer received his undergraduate degree in finance from the University of Rhode Island and received Master of Business Administration with specialization in finance from Lubin School of Business at Pace University. And our last judge is Jordan Kuntz, CFA. Mr. Kuntz is the financial advisor and analyst at Colorado Financial Management, an independent wealth management firm that manages $1.2 billion in assets for high net worth clients and institutions. Mr. Kuntz holds a bachelor's degree in mathematical economics from Panoma College. He received his CFA charter in 2011 and is currently serving as the president of CFA Society Colorado. He's also a certified financial planner professional. Thank you for volunteering your time and being part of this exciting competition. The next, I would like to review the rules for tonight. So tonight we have 6 teams that will give presentations. They will provide the investment recommendation on DaVita, and investment recommendation will be buy, sell, or hold. The presentations will follow by 10 minutes of questions and answer sessions. So each team has 10 minutes to give presentation, and then judges will have 10 minutes to ask questions. After each team is finished, the judges will deliberate on the team's scores, and the next team will be invited to the room. So only the team that is giving presentations is allowed to be in the room. So at first, all the teams will be outside waiting, but once the team is done presenting, they can choose to stay in the room. Same goes for the academic advisors and industry mentors. Academic advisors and industry mentors can choose whether to be among the audience, and in this case, they are restricted from communications with the team, or they can stay with the team, and then once the team is done presenting, they can join the team and watch the rest of the presentations. But the team is not allowed to see other teams presenting before their turn to present. During the presentation, please refrain from the following: interacting with the teams by coaching them in any way, leaving or entering the room during the presentations, or speaking loudly. Also, please turn off your cell phones or put them on the silent mode. It also goes for the Denver Country Club policy that none of the guests are allowed to use electronic devices inside the Denver Country Club. So after all the teams have completed, we'll have a short break, and then the winner will be announced. Winner will be determined based on the combined score of the oral presentation and written reports. So each is worth 50%. And then the winning team will represent the university, CFA Study Colorado, and Colorado at the regional finals in Chicago. So right now, I think it's the most fun event. I mean, most fun part of the presentation. We're going to randomly throw on the numbers that will determine the order in which teams will be presenting. So this is not the true order, but I'll refresh the screen, and the screen will be refreshed, and you will see the order in which your team will be presenting. Is ready? This is the order. It randomly switched a little bit. Yeah, make notes. So right now, the next team will be presented is University of Denver, and then all the rest of the teams, they should leave the room, and you will be called. I think Marcelo is here. He will, Marcelo is there, and he will call the next team when it's time to present. Oh, just a second. Just want to play
This is here. Yeah. Here it is. It's D Metro. Great picture. So it's a select button. There you go. Brightness. Yeah, we've got the audio feed going right now, so everything's good.
I like how we did that. Monte Carlo.
Yeah.
Oh, there you go. Hey.
Yes. Thank you.
Showing up?
Yeah, so this is a clicker you can practice. Take a couple of minutes to practice, go through the slides, make sure the slides look good. You can choose to use a microphone. You can pass the microphone or you can just speak loud. Either way, it's fine. But yeah. Yeah. And you will be able to take your judges. I love that.
Is there?
Yes. Actually, we'll time once you start, give it 10 minutes, and then you will show you 1 minute warning sign.
So we just have the warning.
No. Just 1 minute warning, and then once you time stop. Same goes with the judges. They will have 10 minutes of Q&A. Once your time is up, even the judges on some questions. Yeah, you can also focus on judges. So you can be scored.
Take that softball. What do you want?
All right, so the first team that is going to present this university event, please welcome the youth.
I struggled with accepting my current state and have a hard time finding anyone to relate to because oftentimes I'm the youngest person in my facility. To begin understanding DaVita, we knew we had to understand kidney failure and the trials and tribulations that people were going through who were dealing with it. Dave is a good friend of two of the people on our team who's been struggling with it from a young age. He's a 24-year-old Hispanic male in New Mexico, and we first reached out to him to interview him to understand what he was going through and how he was handling it. From there, once we started approaching it from a more analytical view, we broke DaVita Healthcare Partners into 3 separate portions: Healthcare Partners, Kidney Care, and Ancillary. Here's Jordan Fuentes to talk about Healthcare Partners.
Healthcare Partners is a large physician network based off of capitated patients that has continued to grow mainly through acquisitions. Capitation is fixed payments per patient and therefore results in companies having to find efficiencies within their business in order to create profitability. One way that we see DaVita doing this is with their increased emphasis on preventative care. When modeling HCP, we had to look at a few different factors. We had to look at capitated patient growth as well as the M&A activity within HCP. In addition to the 2 to 3% per annum growth in population, we also added a premium to the capitated number of patients growing 5%, and that was due to the increased market penetration of DaVita. With regards to the M&A activity, there was a recent acquisition of the Everett Clinic in Seattle, Washington, giving DaVita new geographic exposure and also adding in 315,000 capitated patients. When looking at HCP, we had to definitely factor in what would be the worst and best case scenarios and what would impact these. So our worst case scenario involves an exiting of 30,000 patients per year from 2017 and 2018. Our best case scenario, however, involves an acquisition that would add 150,000 capitated patients and would not result in any exiting patients out of the capitated patient network. To move on to the bulk of the business, which is kidney care, I will pass it on to Siddhartha.
So kidney care represents 2/3 of DaVita's total revenue. This is what they're known for. So to understand it, we took it from a holistic view and saw that they model it based on number of treatments. But from there, we immediately noticed they have 2 revenue streams: fee-for-service and capitation. Capitation being the fixed payment that Jordan just explained. Fee-for-service being every single individual treatment is billed on an individual basis. We then also saw that their expenses were modeled as patient care costs, and that represented 67% of their expenses. So to look into this, we dug into their financial statements and found this was predominantly operating expenses for dialysis centers. So what this told us was that kidney services is strictly dialysis centers and working with ESRD patients. We also saw that their DaVita's management talked about reimbursement rates and regulation and their sensitivity to that. So we factored that in. When we modeled it, we said, let's first of all look at the number of treatments, as DaVita did. What we did was look at CMS, the Center for Medicare and Medicaid Services, their own projection data for ESRD patients for the future. We then added a 3% market premium to that to account for DaVita's growing market share. From there, we then looked at their two revenue streams, fee-for-service and capitation. Fee-for-service has remained consistent in the past, and nothing in the regulatory or in the market has suggested that it's going to change. So we've kept it consistent. But Medicare announced a cut of about 0.57% in their Medicare Advantage plan. So for our capitated revenue, we incorporate that into our capitation growth, so we have the cut there. In our scenario analysis, we said the big thing that they are sensitive to is capitated revenue, specifically reimbursement cuts or boosts. So for our worst case scenario, we added a cut of about 0.5% because that's what we've seen happen in the past. For our best case scenario, we said, what if there's a boost? So we added a bump up for their capitated revenue of 0.2% because when you have a boost, it's typically smaller than when there are cuts. Our final segment was ancillary services. This represents mostly operations that supplement kidney care, the biggest being DaVita Rx. DaVita Rx is a medication service for ESRD patients. The big thing we found was that DaVita has leveraged their size and success in order to work contracts with companies like Amgen to provide medications for these patients, helping keep their costs down. One thing we were actually impressed with was DaVita does so well here that their biggest competitor, Fresenius, contracts with DaVita Rx. It's been really good for them. But historically, they've been growing a bit faster than kidney care, but they've been leveling out. So to project it, we modeled it parallel to kidney care. To tackle the financial analysis, here's Shuhan.
Thanks. For financial analysis, we break the DaVita down to three parts: profitability, solvency, and liquidity. To understand profitability, we carefully analyze the income margin. DaVita's net income margin has continued to contract since 2011 and is uncompetitive when compared with its main competitors. The number of patients has increased, however, 90% of these patients are capitated patients, and treatment costs are at a similar level. That's one of the reasons why margin contract in the past 5 years. Another thing that dragged the margin down is their legal segment, especially the case in 2013 and 2015. DaVita has a very high level of that, which accounts for 60% of its capital. Its debt-to-equity ratio is much higher than the industry average. Actually, one of our questions posed to the management is regarding solvency. Management explained the issuance of 10-year bond in 2015 was to take advantage of attractive interest rate. They retired some existing bond in order to generate interest savings. In addition, they raised some money for general corporate uses, including acquisition and share repurchase. So we are not so worried about its solvency because the debts are expressed out evenly in the following years. So given their strong, stable cash flows, the higher debt ratio seems reasonable. Finally, liquidity. DaVita's quick ratio is much higher than its competitors. Even though legal segments have adversely affected its net income, they do not cause a problem to liquidity. DaVita is subjected to legal segments due to its nature of business, so we have to take this factor into account in financial analysis and valuation process. Let's take valuation. Jordan, please.
When valuing DaVita, we use two main valuation methods: a discounted cash flow and a price to earnings multiple. Within the discounted cash flow valuation, we used our segment projections to forecast the future cash flows to the firm. And aside from our growth and discount factors, we also had to factor in an increase in CapEx, as was indicated by management. We did this as a percentage of revenue and added a premium. We also increased the amount of net working capital, as the recent acquisitions is definitely going to tie up some intricacies in the balance sheet, and therefore had to factor that in as well. DaVita has shown a tremendous ability to generate cash flows, and we believe that this method is very representative of their ability, and therefore have weighted it at a much higher rate than our price to earnings. As you can see from our price to earnings analysis, we did arrive at originally at a 17.6 times, but we did add a premium to that of 4.4 times in order to account for the increased growth rate of DaVita when compared to competitors. This increased growth rate is mainly due to M&A activity. And DaVita also has shown a great ability to generate earnings with over a past history of a decade of being able to do so, and therefore believe that this is a great valuation method supplemental to our discounted cash flow. To continue on with our scenario analysis to the firm, I'll pass it back to Charlie.
So as we mentioned before, the combination of our three different scenarios, our worst case, our base case, and our best case. Our worst case, we saw a shrinking capitated revenue along with an exit of patients. Our base case, we had a small decrease in capitated revenue that we see out in the future through legislation, but a serious increase in capitated patients. And then finally, for our best case, a small increase in capitated revenue and a significant increase in capitated patients. We felt that our best case had the highest probability of coming to fruition. We have extreme faith. DaVita has exceptional employees, and we have great confidence in their management, but we do have some concerns as well. Reimbursement rates are being shrunk, and M&A activity within the healthcare industry has been facing some of the highest multiples it ever has. The industry is extremely turbulent, and there's a lot of uncertainty when you have so much exposure to government reimbursement rates. We recommend a hold with a target price of $69.50 per share. We're excited about DaVita expanding themselves to New Mexico. We're excited about the firm, and we can't wait to be able to tell our good friend Dave that he's going to be able to go to the DaVita Center soon, one nearby his house, where he'll be put into a community and have exceptional care that he hasn't been able to experience previously, where he's been receiving his treatment.
Thank you.
So the next stage is for judges to ask questions when they are ready.
Could I get a little bit of additional explanation or color on how you got an 8.1% growth rate in your?
Yes. So that is off of our segment projection. So we did a kidney care projection and also an HCP, and the way we tied in ancillary was we drew that off of the growth of kidney care as well. So our 8.1% is a compounded annual growth rate of our growth of revenue to the firm as a result of our individual segment projections.
You assigned a premium to the valuation, so you did 30% of your model was a
Yes.
PE by comparison. You assigned a premium because DaVita, you said, had a advantage over the competitors in M&A.
It was because they were
because
of the increased growth rate, and that increased growth rate is mainly due to the M&A activity taking place inside.
the advantage they have over the competitors.
It's strictly the physician network that they require. HCP as a business sort of sets them apart from all other competitors. The big competitors are really Fresenius. Nobody else is really in this market like DaVita is, and Fresenius doesn't have a network. So there's nobody really doing it like DaVita. That's why we had said that premium.
What caused you to change your outlook, either to the buy side from your?
I think huge success within their HCP division. We see that as their biggest opportunity for growth. Based upon our models with ancillary services and kidney care, it's very closely tied to government reimbursement rates as well as population increases along with the certain condition. However, their HCP, as we mentioned before, they are one of the exclusive players in that area, and due to the ACA or Obamacare, there's a huge amount of physician care and doctors turning to networks, and DaVita is well positioned to take advantage of it.
So on patient services, that's the kidney care side.
Yeah.
So total treatments, 2015, you have a 10% growth.
Yeah.
In the last few years, it has been between 4 and 6%. So how do you justify 10% growth in that year?
That one was from CMS. They put out their projections for going from, I think, 2010 through 2018. And from 2015, they saw a big population growth in ESRD patients. That's where our 10% came from. We used theirs, and we kept our premium consistent at 3.3% for every year to account for market share growth. But the rest of the growth rate comes from CMS.
And did you take into account the commercial side of the patient population? Because there are government patients and then the non-government.
The private insurance side. We took that into account for our fee-for-service revenue stream. The number of treatments was global for both sides.
With a 60% debt to equity ratio and a rating of AA, any thoughts on what the potential for higher interest rates over the next several years could mean, not only to the existing balance sheet, but also to future acquisition strategies?
Yeah, I'll take that on. So their debt is definitely, a cause of concern. That's why they did ask management about that. And they did explain that they use the EV to EBITDA, or not EV, debt to EBITDA multiple instead. A big thing is that a lot of the debt coming online for the debt schedule is coming online after 2020, which would definitely have a huge impact with interest rates. So, that's definitely something that we have to keep an eye on. And one of our big risks with DaVita, especially being a non-investment grade company. And, another large thing, as you were mentioning, is, DaVita has this current share repurchase program. So how are they going to raise some capital in order to, acquire another firm if they need to do so? Well, one, DaVita has a great ability to generate cash flows, so it's not too concerning there. But with this debt due, this here is about $700 million, and that's less than 10% due afterwards. And we have faith in DaVita's management in order to, gain attractive interest rates as they have just done with their retirement of their, I think it was 6.25% bonds in favor of 5% bonds.
Do you know what component of the cost of goods sold the drug cost is that Evogen, that they contract with Amgen, what percentage it is for them, and how you're modeling that for your expenses?
For total drug expenditures, the percentage was something like 70, 73 or 74% of the ancillary, of the DaVita RX costs. In terms of the specific contract, we spent a long time actually looking for that and couldn't find anything about its contribution to those savings or the whole cost structure in general.
A bit about how you arrive at your worst case and best case scenario, the numbers you used.
You want to go first with kidney care? Or
So for our worst case, like I said, the big thing that they were sensitive to was capitation revenue changes, because fee-for-service has been historically consistent, and number of treatments that they've performed is sort of down to the market. If there are more ESRD patients a given year or less, they don't have as much control over that. And that seems to also be fairly predictable. The capitation, especially from the government side, can change and then have a big effect on them. So 2/3 of their total revenue on that segment is capitation. And so what we did is we said, since that's where they seem to be the most sensitive, let's use that as our basis for our scenario analysis. For the specific numbers, for our worst case, we cut it by 0.5% because at the end of last year, CMS already announced their cut of 0.57%. So we said if there's another cut, probably similar size. For our best case, we said, okay, best case is obviously they get a boost. And so we said, is the boost going to be of similar size to the cuts? Probably not, because securing funding is intrinsically more difficult than slashing. And so we said, if they got a boost to this same funding, we don't expect it can be as much as 0.5%. That's why we assigned this one 0.2%.
And regarding the HCP side of the business, management did tell us that they exited 30,000 unprofitable customers at the end of 2014. And we took that into account in 2017 and 2018. And I do know that, taking out unprofitable customers does sound like a great thing, and it is. But DaVita has had them in their network for X amount of time where they are unprofitable to DaVita. So we had to take that into account. And for the opposite side, we increased their capitated patients by 150,000, and they did not have any exits of unprofitable customers. Therefore, there was no downside drag on HCP before DaVita could notice these customers and exit them from their network.
Just a question on management. So there's been a lot of turnover in that CFO position. How do you think that has impacted and potentially will impact DaVita going forward? Seems like it's hard to get someone to stay in the seat next to Ken.
I think it was a certain point of concern for us, but we felt so strongly about the rest of the employee base that they have. I mean, we went so far as to even reading reviews on Glassdoor and trying to get as good of a pulse on company culture, how people felt about working there, and their passion for it. And it seemed to just be really a strong point for DaVita all the way around. So we're confident that they'll be able to find somebody to fill that CFO position once there's just the right cultural fit or they're not incentivized to leave for something else.
I think their strong history of earnings and cash flows speaks for itself. And so, yes, there's a high turnover for that position, but like Troy said, we're confident in the way the rest of the company operates. That specific position doesn't really seem to worry us.
Does the stock pay a dividend?
No.
No dividend.
No dividend. And then management has indicated that they will not do so.
But they do share repurchases.
Yes.
Yes.
So that's philosophically.
Is that Purple managed? Should I buy this or their competitor business?
Can you repeat that?
Should I buy this stock or their competitor stock?
The one thing, and we were looking at that, we don't think so. Because there's one thing CMS, they do this star rating program for all the dialysis centers. DaVita's consistently in 4 or 5 star, majority, it's 83%, I think. Fresenius is not. They have about 1 or 2 star. And when you ask DaVita that, same question you just did, that's what they'll tell you is, our facilities are rated much better than Fresenius. We're much better than comp. You know?
There's also huge benefits with reimbursement regarding the star ratings. DaVita just has the lion's share of the 5-star rating. So they don't only do the best, but they have the most profitable ones. It's recognized.
All right, time's up. Thank you.
Thank you, guys.
Thank you. Thanks very much. Thank you, sir.
Thank you.
Thanks.
So the next judges will take 5 minutes to finish putting grades, and then the next team will be presented is Metropolitan State University of Denver. I love to see it.
How you doing? Good, I'm Tom. Yeah. Having a time. Okay. Yeah, okay. Yeah. But then came back.
Thank you.
Well, I guess I had it.
It's USB charger. I feel like I got half a full charge.
I didn't know that you could be here.
So they were all, that was tough. The other interesting thing is so that was kind of interesting. You got to have different industries and everything. It was kind of exciting. But they were all definitely easier.
No, I don't. I did.
I remember pulling in and seeing all these license plates. Felt bad for me. I had like a 20-minute. At the time, it horses. New York City,
Don't have to do one yet.
Judges to All right, so the second team to present is Metropolitan State University of Denver. Please welcome Metro.
Hi, everyone. Thank you for coming today. My name is Scott. These are my colleagues, Caitlin and Evan. We represent Metropolitan State University. DaVita is the largest U.S. provider of dialysis services and operates in 3 main divisions. We got kidney care, who primarily focuses on dialysis, end-stage renal disease. We have healthcare partners, which is a network of medical groups and physicians. Then you have strategic initiatives, which is usually smaller endeavors that are more experimental or either support HCP and kidney. It's important to note that the data provided in our group is cut off on January 8th, 2016. And we issued a whole recommendation with a $77.69 price target, offering a little less than 50% potential.
All right, moving on to their corporate strategy. DaVita's mission is to be the provider, partner, and employer of choice, which indicates that they're pursuing a differentiation strategy. A couple elements of their strategy we want to highlight. Maintaining market share, very important, especially on the kidney care side. They're pretty much neck and neck with DaVita, sort of a saturated market operating in 46 states. And then growth through acquisition as well. Historically been very important for kidney care, and in the future will be very important for healthcare partners. That chart on the bottom shows historical acquisitions. As you can see, the rate has been declining a little bit, but still plays an important role in the company.
We do find their CEO, Ken Theory, a key driver within the company. He took over in 1999 when they were Total Renal Care. They rebranded into DaVita when he came in. Total Renal Care was in failure, and he had to renegotiate with creditors and shareholders. There are 6 different committees that create up their corporate governance.
DaVita operates in the healthcare sector, which represents 17.5% of the U.S. economy. More specifically, most of their revenues come from the professional services industry. We believe that the healthcare sector is less prone to economic downturns, more sensitive to the health of the overall country.
Right here, we do have a graph of adult obesity projections. In-stage renal care ends up with a patient having to go through a kidney transplant or dialysis at that point in the disease. And the disease is linked to high blood pressure and diabetes, which are both correlated with obesity. The American Journal illustrated that 35% of Americans are obese currently. Right here we do have a graph of the prevailing growth rate, which is growing at 20,000 patients per year.
On to competitive positioning. On the left, the Porter's Five Forces analysis. We broke it down between kidney care and healthcare partners. As you can see, the threat of new entrance is a little bit lower for kidney care, but they face a very high bargaining power of buyers. This is due to them being kind of a price taker for their 90% of the patients covered through Medicare, Medicaid, other government subsidized plans. It's hard for them to influence the rulings on the rate increases. There's a high intensity of competitive rivalry on both segments. On the right, a breakdown of the U.S. dialysis market share. Like I said before, neck and neck pretty much with Fresenius. Many geographical regions, they operate almost as a duopoly.
Right here, we do show that Buffett actually does have, now it is currently over 18% of the shareholder breakdown. However, we do like to emphasize the debt that DaVita currently holds. They currently just issued in April of this last year $1.5 billion of a senior note that will be due in 2025 at 5%. They do have a large structure of equity within the company. However, we do not find this as harmful to the company as that it does play a key role in their acquisitions.
Moving on to revenue breakdown. Traditionally, U.S. dialysis and related lab services provided the bulk of their revenue. It's still, as of 2014, 2/3 of their operating revenue. On the right, like I was mentioning before, again, just to note, 10% of patients within kidney care covered on commercial plans, but these 10% provide 33% of the revenues. That just illustrates DaVita's reliance on those commercial payments and the higher reimbursement rates from those plans. Moving on to returns and margins. On the left, an EPS breakdown. These are adjusted EPS numbers, taking out legal settlements, which we'll talk about more later. A lot of growth over the past few years. However, year-over-year growth is sort of started to drop off. I also want to point out the margins. There's kind of been downward pressure on the margins, and DaVita at this point is struggling to maintain and keep a steady net profit margin.
Since 2008, DaVita has experienced pretty free cash flow is kind of all over the place. As you can see by the chart represented in the gray, it's fluctuated from 100% growth rate to negative 20%. And we projected to, in 2015, we projected to be negative 35%. If you take a look at the free cash flow as a percent of revenue, it's a lot more stable, and usually it's around 10%. Taking a look closer at kidney care, in 2014, they made $65 in operating profit per treatment. And while that's the highest it's been in a while, it's also important to note that the patient care cost growth rate per treatment has grown at a higher rate than the revenue per treatment. As far as non-acquired growth rates go, DaVita is leading the industry with a 4 to 5, that typically ranges of 4 to 5%, while the industry ranges from 3 to 4%.
Now we're entering the evaluation of our presentation. We evaluated the intrinsic value to be $77.69. This is an average 50-50 between the discounted cash flow model, which includes these elements. We felt like it brought in a great portion of historical numbers as well as economic factors, as well as the comparable company analysis brought in a multiples approach.
All right, so talking about the discounted cash flow analysis and the assumptions, first thing we had to do was establish top line revenue growth. We did this. We broke down and did it by sector. On the top left shows that chart. These are pretty much based off historical averages. And then to calculate the weighted average cost of capital, we used the 10-year treasury as a proxy for the risk-free rate at 2.25%. We measured beta at 0.659. That was weekly returns over the past 5 years versus the S&P 500. Using the capital asset pricing model, we ended up with a cost of equity at 7.4%. Cost of debt at 4.8% based on a similarly rated company for them to issue new debt. Ended up at a WACC of 5.80. We took a look at free cash flows to the firm and free cash flows to equity, but felt that free cash flow to the firm was a little more appropriate because DaVita's constantly changing capital structure, and that yielded an intrinsic value of $76.80 per share. We also did a sensitivity analysis. On the left plot of that, as expected, the share price is most sensitive to the WACC. But somewhat interestingly, we built in $250 million of legal settlements per year into the model, and that had the second greatest impact out of all of our assumptions on the share price. On the right, we did a simulation analysis, Monte Carlo with 10,000 trials, just to validate the model.
Our comparable company analysis resulted in an intrinsic value of $78.57 per share, which was comprised of 4 different multiples that we weighted evenly. We ultimately decided to go with the mean averages for our calculations, but the chart on the left shows the differences between using the comparable mean and the comparable median.
DaVita does face many risks. 2 of the main ones we'd like to point out is the healthcare reform risk. This is as that 90% of their patients are on government plans or government subsidized plans. The other risk I'd like to hit on is the compliance risk, as that they have had lawsuits over the past 4 years equaling about $1 billion. This past May, they actually had a lawsuit payout of $495 million, and so that is why we have factored in that $250 million a year, as that it does seem to be a fairly consistent happening.
All right, so in summary here, in conclusion, we want to reiterate our hold recommendation with a 77.69 price target. As merits, we see since the $4.4 billion acquisition of Healthcare Partners in 2012, they've diversified their revenue sources and continue to do so. They face favorable industry demand as well. And then Ken Theory and his team of management have also provided, have been important to the company. As concerns, again, the reliance on commercial payments, patients, their regulatory effects, just in general, the margin squeeze. And then lastly, compliance and legal settlements, these are very hard to predict and heavily impact the free cash flows to DaVita. That's it.
Thanks for your time, and we're ready for some questions. Bless you, by the way.
Thank you.
Sure, I'll go first. Could you go back to the multiple slide? And talk a little bit more about the how you came up with the ranges for various. Were those just?
Okay.
Oh, go ahead. Sorry.
So for each multiple, we calculated the peer mean and the peer median, and we ultimately decided to go with the peer mean because it was a relatively small peer group and there were no outliers as part of the group. And so what we did was we calculated the mean and the median and showed the differences right there on the left, because that is kind of the major assumption in this as to which was more.
And typically what I've seen is just for follow-up, more so the PE is looking forward.
Mm-hmm.
How did you arrive on trailing 12 months? That seemed a little odd to me.
I mean, we took the 2014 and then kind of looked at the trailing PE for everybody else.
Yeah, I mean, just to add on, we used trailing 12 months, mostly just when we cut off our data at January 8th. There had been kind of downward pressure on the markets, and you can see that reflected in the next 1 month's PE, the forward PE. So it just seemed to kind of be prudent to include that as well.
What steps is management taking to address those legal costs? You have a fairly substantial $250 million ongoing cost. When you met with them, did that come up? Did you guys have any insight there?
Yeah, and we did. That was one of our follow-up questions that we emailed. They said, you know, part of these are just been ongoing cases, you know, stemming back to 2009 through 2012. They've since then, and especially over the past year or two, said they've invested significantly in their legal and compliance departments. I think there's also a seller's escrow with healthcare partners, like $600 million. If any issues should arise from that merger.
Yeah, their compliance group as well is definitely trying to step in there. Like Evan had mentioned, that was one of our questions. It wasn't specifically too clear on their answer of what exactly, other than they were just giving more funding to that sort of group in the company.
You mentioned there's been just kind of continued downward pressure on margins that's concerning you. But one of your charts on page 12 of your slides shows kind of moderating the treatment costs over the last year. Can you kind of reconcile that and maybe what you're modeling in out years?
Okay, well, when we say that patient care costs are exceeding the revenue per treatment, we primarily mean for 2014, they exceeded it. I mean, we projected it to be relatively flat. I mean, we said zero, we just said zero growth, just basic assumption. But that's kind of a judgment call as how we would forecast that going forward.
Yeah, I think patient care costs historically end up being about 70% of total revenue. And it just is sort of this reality that they, and again, this is kind of one of the things that came up during the corporate presentation. It's just kind of the reality that they have to adjust to, and just really, work on those commercial patients and the rates kind of on those lines.
Just a follow-up question on the lawsuits. You had mentioned that approximately $1 billion has been paid out in the last few years for settlements, judgments, etc. Is there anything else out there that's pending, any major class action lawsuits or anything that could potentially come up in the next few years?
There are quite a few future-looking aspects that I did see. It seems like there was a breach of fiduciary responsibility for a physician that came up. In southern Colorado, there was one for it was a type of driving a patient wanted to the clinics, and there was another one this past year in 2015 when the Office of a General Inspection requested some paperwork, and DaVita said that they were working with them to provide them their paperwork. So there was a few ones in there that could continue to lead to that, yes.
So what would have to change with the story to get this to abide?
In 2014, there was proposed of a 10%, almost a 10% rate cut, and I mean, DaVita is a very quality company. Okay? There's no doubt about it, but it's very concerning that factors like this are out of their hands that can just substantially affect their margins. There's nothing really they can do. So I mean, for us to go ahead and throw a buy on it, we'd have to see a lot less pressure as far as reimbursement rates go. And
yeah, it's also very difficult. They're under a lot of pressure to grow HCP, and the acquisition opportunities might not present themselves. They just over the past few years, like when they enter new markets, usually they find the best way to do it is to just acquire an existing physician practice or managed care network, that type of thing. But those opportunities might not always present themselves. So a lot of uncertainties.
The government regulation is a big aspect where many companies out there, if you can control your quality and your efficiency and such, you can build yourself up. But as 90% of their patients are on these government subsidized plans, it is very difficult because of the reimbursement rates. If the government decides something, they're hurt by it without any control from within.
What sort of modeling did you do for you mentioned the obesity rates increasing. Did you build that into your DCF models in terms of potential increase in the number of patients then, all else equal?
Yeah, well, again, it's kind of just based on it just kind of factored into the revenue growth, the top line revenue growth, because those rate increases are usually about 1 to 1.5%. I think where they make up the rest of that, at least within kidney care, is the increased capacity and amount of patients they're treating. As far as factoring in, specifically the obesity rates, again, it was mostly just kind of a historical average, and then also there was a little bit of company guidance. I think they said their operating income that they expect is 3.5 to 8%, and so 5.5 split that on the kidney care. Again, assuming kind of a flat margins.
You highlighted their strong cash flow generation. Why don't you think they pay a dividend?
We believe the reason they don't pay dividend is because they would rather put that money towards acquisitions. And so we do believe it is a possibility that we could see DaVita paying a dividend in about 5 years, depending on how their acquisition rate continues. But I mean, they believe, Warren Buffett probably has something to do with that. They would benefit shareholders better if they just continue their growth by reinvesting that money in the company.
Yeah, and as a matter of fact, that was one of the questions we also asked, especially noting their share repurchases first 9 months of last year, $424 million. It was just seemed kind of odd to us because, if there weren't these opportunities, I think they just are very cautious to kind of have that obligation continually. A lot of companies are too, especially when it comes to raising dividends. But for now, they're gonna, try their best, focus on the growth.
On your pie chart, I noticed the 1% difference in market share between DaVita and their largest competitor. I'm just wondering if you can summarize very quickly what, in your estimation, is the biggest difference between those two companies.
Well, Fresenius, they have much larger international operations, and they also have kind of been spun off. They're a German company. They have a couple other ones that do more in the hospital side of things. Basically, since 2005, DaVita acquired Gambro, and they've just kind of been trading back and forth that top market share since then through usually acquisitions. But again, as far as the biggest difference, I think just the international operations, and then Fresenius, at least the one that we looked at, the numbers focused only on dialysis, and DaVita since then a little related to diversification.
All right, it's time.
Thank you so much.
Thank you. So that was Metropolitan State University of Denver, and the next team to present will be University of Northern Colorado, UNC. Sorry. Okay, sorry.
Yeah, 2 or 3. Thank you. You should do it. Yeah. Wow, yeah. I'm not sure. What's your for your Denver.
Yeah.
What was it? Broncos is expensive.
$14,000 per season for an 8-seat. 14,000. So that's the process. I've never been to this.
Just for where no, I'm just, lucky to have some friends. No idea.
Why do they keep using revenue? Isn't Jesus? Sounds twice in a row. And so,
You moved downtown?
there's easy, right? It's easy. Right.
Yeah, I will miss him. I told him.
I said, okay.
Yeah.
Sorry to see.
The lighting was great. Thank you so much. Sit down, well, just in the flexible break, I readjusted for the new lighting. We don't have as much. I think this next.
What have you guys-
this next presentation is going to be the one time. Everybody's going to stick around.
Start right here.
Oh, boy. 5 years. Check.
So, and that's for the presentation. I actually want to start. You know, it's two lights. And I give them that, I object. So, the other thing, that's the presentation. And those are done, so judges. So it's essentially the same thing. Judges email communication.
All right, so the next team to present is University of Colorado, Denver. Please welcome the senior
Okay, good evening, ladies and gentlemen, judges. As we already said, we are the University of Colorado, Denver CFA research team. We have a buy recommendation for DaVita. My name is Patrick, and I'm going to get things started with the company overview. So DaVita is broken down to two main divisions. Their kidney care and their healthcare partners. Kidney care is primarily responsible for their kidney dialysis and their lab services, whereas the healthcare partners is in charge of the overall healthcare management system. They currently operate about 2,200 centers within the United States, about 100 centers globally. Institutional ownership is comprised of about 84% of the total ownership of DaVita, with Berkshire Hathaway being their largest owner at about 20%. So as I said, we have a strong buy recommendation with a target price of about $92, gives us an upside of about 34%. The qualitative reasonings behind that, there's a very strong population growth within the United States, coupled with increased diagnosis of end-stage renal disease. DaVita currently has really strong cash flows, which sets them up for a very favorable position to expand their kidney care division internationally. I'm now going to pass it off to Hillary, who's going to continue with the industry overview and the competition. Hillary?
Thank you. DaVita has international market dialysis globally. It is one of their strategies to has an exposure in international market. In 2014, DaVita has 91 centers open up, but recently they opened up more centers in the second half of 2015. DaVita has a strong competitive advantage, and the company has a strong company culture with an experienced management in the healthcare industry. DaVita DaVita is ranked 5-star by the CMS ranking system because it's quality care to their patient, and also holds 34% of U.S. dialysis market. We use the quarter 5 forces for the company industry overview. Due to the inelastic demand, there's a little threat for substitutes, but also DaVita's main competitor is Fresenius, which is their biggest competitor, holds more in the global market. And also, due to high barrier, there's a little threat for the new entrants. The company demand drivers is the increase in the U.S. population growth, and also the increase in the baby boomers 65 and above. And most importantly, the increase in the U.S. diabetes growth in the future will be more favorable to DaVita in their kidney care section. As you can see, DaVita's ROI for the last 5 years has always been higher than their competitor, even though Fresenius holds 37% in the U.S. market dialysis. And also, as shown here in the index stock chart, DaVita always outperformed their competitors, even with the recent market dip. Now I'm gonna pass this on to Aaron for the financial valuation.
So DaVita all around, their financials are just strong. Going past 10 years, the total revenue has just increased year over year. In fact, in the last 10 years, they've had a CAGR around 90%, which is pretty impressive. Even eliminating their acquisition of HCP, it's still around 60%. The last couple of years, their quarter growth in revenue has never dipped below 7.5%, which is very impressive. Their segmented revenue, obviously their bread and butter is going to be their kidney care, constitutes the majority of the revenue. However, HCP is contributing a larger and larger factor, constituting a fourth of their current revenue, and we expect it to continue. A note that we should make is commercial payments make up about 10% of their dialysis, which make about 33% of the revenue, and most importantly, the profit margin. The commercial, just their 10% of patients alone constitute about 115% of the profit. They actually lose money on their government. So the government payers, including Medicare, Medicaid, the VA. So it's very important for management to keep up their commercial entrance of patients. Their net income growth is in conjunction with the revenue, just consistently up. We don't really expect that to change anytime soon. Earnings per share along the same line has slight flattening out, but for the most part, the trend has been up, which has been great for investors. Their debt and equity might be a little disconcerting. They have a BB negative credit rating. This industry has a high leverage, high debt to get into the market. With all the acquisitions, it costs about $2 million for each new dialysis center domestically.
So it may be a little disconcerting, but even to lower that, the cash flows for the company have been very solid. LTM 2015, they've been about $1.3 billion. And as you can see over their scheduled maturities, which are very spread out, they shouldn't have any problem paying off their debt. So we did a DCF analysis and a multiple relative valuation for our price target. We had to make some assumptions for our DCF, first being revenue. Looking historically at their last 10 years, we made some assumptions. We kind of took a little more conservative approach due to some international expansion barriers and difficulties, as well as domestically, they're going to reach a tipping point, maybe face some antitrust laws with their kidney care as they control over a third of the market. So for our WACC, for cost of equity, we ran a beta. We calculated our own beta, running regression against the S&P 500. Cost of debt, we did a comparable BB negative spread. Using our capital weights of 32% and 67%, we came to a conclusion WACC of 6.5%, which was in line with most industry experts. Bloomberg had around 6.7, 6.8, so we were feeling fairly confident with our WACC. For our relative multiples evaluation, we looked at industry and even closer to the sector. We chose companies with an enterprise value of above $1 billion, and then did our EBITDA multiple, which the average, and we calculated about a 9.1 multiple. The reason we chose enterprise value over EBITDA is kind of industry standard, just because you eliminate the underlying cap structure, makes it easier comparing apples to apples for companies. Comparing them side by side, the enterprise value, we calculated around $27 billion for both approaches, which led us to equity value per share around $92 for both methods. Using our weights, which we use equally around 50%, we calculated a 92.23 price target. Now I'm going to pass it on to Jerry, who's going to do our sensitivity analysis as well as our statistical analysis.
In sensitivity analysis, we have a combination of different scenarios based on the different WACC, long-term growth rate, and EBITDA multiplier. As you see, only a very small portion of the internal rate of only small portion of intrinsic value per share was below the current market price. So in other words, we believe that market price is undervalued. And based on the current stock market and the macro and microeconomic perspective, we're really interested in variables including 10 years treasury bond, federal funds rate, S&P 500, and medical Medicare index. So we have a summary of the historical data right here. Then we run the regression. So as you see, we have the adjusted R squared as 88.5%. That means 85% of the historical data starting from 1995 can be explained by this model. And no factors has a p-value above 50%. So that gives us confidence to keep all the variables right here. We also do the multilinear test. As you see, we have a 5.45 variable inflation factor. And it shows like the model is effective enough. Then based on our reasonable assumption, we expected that the expected market value 1 month later, starting from January the 4th, would be around $64 to $66. That supports our evaluation methodology and give us confidence to have a buy position. Now I'm going to pass to Keegan for risk analysis.
Thanks, Jerry. Looking at DaVita's risks, obviously being a health services industry, DaVita is subject to massive federal regulations, and they need to make sure that they stay in line with these regulations, as well as adapt quickly to any healthcare reforms moving forward. DaVita is also the subject of a number of legal investigations as well as federal investigations. If they want to remain out of the legal spotlight, that'll help them moving forward with public image. Expanding internationally, DaVita investors would feel better if DaVita understood the markets that they're getting into, and having strategic alliances with local companies to be able to leverage that knowledge base in order to thrive in those markets. I'm going to pass it off to Patrick now for a few closing remarks.
Thank you, Keegan. So to summarize, despite some of the concerns we've heard in the presentation, we're still confident in our buy recommendation. Target price of about $92, giving us a 34% upside. Reason behind that: strong, effective management. I'd like to thank the audience and the judges for allowing us to present and open the floor to questions.
So you spent a lot of time on your DCF model, and the cost of capital was pretty low. Did you look at the scenario of rising risk-free rates and maybe how that might impact the valuation should the Federal Reserve maybe raise the risk-free rate?
Yeah, I would have, given that they may or may not in the near future, just given the market and volatility, even if they raise it 0.25%, it really doesn't affect the up price. It's still around like 85, or sorry, the target price is still around $85, $86. So it's still a very strong buy, even with the expected interest rate hike. And this is a 1-year horizon, so we're not expecting too many interest rate increases, especially given the volatility in the market and the pressures from China.
Can you comment on the recent history of the company's margins, specifically the net profit margin, and how you might reconcile that with your $92 price target?
So looking at their, looking just specifically for gross margin, it's around 24%, which is kind of in line with the new standards. It's actually better than the competitor for Fresenius. So given with their valuation, their multiple was at 9 versus Fresenius is around 11.5. So, and their operating margin is higher. So we believe that that kind of flows into that as well, given our target price.
Besides, the HCP accounted for much of the profit margin in the previous couple of years, and we believe that the HCP will continue to expand and have a higher margin, but the marketing capital expenditure will affect the cash flow. But we believe, to a conservative perspective, we believe that it's gonna continue like a 7 to 10%.
Thank you.
On the multiples analysis, did you consider doing a sum of the parts?
I believe we didn't consider doing some of the parts during our evaluation.
Just as they're different businesses, and actually, could you go to the slide? I guess were there any what companies didn't make the cut as you guys contemplated who to add here?
The company that made the cut has to have like a cap of like $1 billion and above, so then we made the cut.
We chose in a similar sector. It's kind of difficult doing a multiples analysis with DaVita, seeing as HCP constitutes a large percentage of the revenue. So they're not strictly dialysis, but we chose obviously their largest competitor, Fresenius, which had a higher multiple. But kind of the industry standard, and we made sure that the EV or EBITDA were kind of in line with the average. We didn't want any, that's why we didn't choose any companies under a certain enterprise value, because usually their multiples are a little strange. So we felt pretty confident with the section we chose.
Thank you.
Go back to the slide to feed forward on the model that you used. Just make sure I'm understanding. It's the progression. Yeah. Starts here and then the next page. Okay, so this model, was this explaining the historical share price, or was this explaining the your projections for the share price going forward?
The purpose of the statistical analysis is to give the creditors and investors an idea how the expected market price would be 1 month later, starting from January 4th. Mm-hmm. So it's gonna be a reference to support our valuation methodology and to see whether if it is a strong buy position.
And on the next screen, actually, sorry. There we go. Okay, so expected market price there, 63 to 66. That was just looking 1 month ahead then?
Month later, which looking at the stock price today, yeah, 65. I mean, it's accurately portraying what the price is.
And how did that come around, and how did you use that to support your?
We're using it as kind of a base case to see because we were doing a lot of the model analysis in December and November, just kind of used to see, we were trying to expect what the price would be in January to give us a better analysis of what the price would be to give us the 34% upside, or just assume what the upside would be.
How far out did you have to go? And we're asking questions around. How far out did you have to go to get to that $93 price target?
With the TCF model?
Or I guess this model, so this was, you're using this as a way to.
We didn't use it to
It's basically a unique characteristic that we use to help make our ultimate decision. Our main valuations for the relative multiples and the DCF models. We did this really to kind of get an idea of where we'd be at initially to see how it would work.
Yeah, based on the current stock market volatility, we just assume that the stock will keep volatile, and to see how the volatility will affect the stock price, to see if we have a long position is right or not. So
I did their third quarter conference call, and they buy back a lot of stock. I think they're on pace for maybe something like 600 million of share repurchases for the full year. How much of the EPS growth do you think is due to the share repurchases versus the kind of organic performance of the business?
To be honest, I had just realized recently that they had bought all those shares up, so it didn't play a large part into what we were looking at initially. But now, now that we had seen that and looking back on what we had done, it certainly would have factored in. And if we were to do this again and we had that information, it definitely would have affected.
I think also in addition to why the price increased, they had stronger expectations for 2016 with the third quarter, so they're kind of upping their what the company was going to do. So I think that definitely contributed to the valuation.
You started to talk a little bit about legal issues, but I'm curious, what's the one thing that could occur over the next 12 months that could derail this story, in your opinion?
I strongly believe that strict adherence to their corporate integrity agreement could spell a lot of damage for DaVita. They're being watched right now heavily, and it's, I think the Office of Inspector General is kind of making a point with this corporate integrity agreement with DaVita, and I think it's a message that's being sent out, sending shockwaves through the industry. So strict adherence to that, and I think if they can manage to do this and come out on top, that'll send a message back to them as well. But like I said, I think that's one of the main things that can happen. Staying out of any other legal proceedings as well, just keeping that moving away.
So I think in Q3, the non-acquired growth for DaVita is about 3.5%, and it's also signaled or showed a crossing of the lines of growth for Fresenius and DaVita. Does that give you pause when you think about? I think in your model you have 5% growth going out into the next 5 years and beyond.
Yeah, it definitely played a role. As I was saying, domestically, they have 34% of the U.S. market. So we're really putting a lot of promise in HCP, especially because they only have like 6 states, and they have the 3 legacy states in California, Nevada, and Florida. So they have so much room to grow with HCP. They have experienced management in the healthcare sector behind them. Also internationally, in 2011 they had 10 or 11 centers, and now in 2015 they have over 100. So the strong cash flows, I think they're just going to keep outperforming.
And just to add to that, we think that the majority of DaVita's growth over the next couple of years is definitely going to come internationally. They own about 34% of the domestic market currently. I believe that gives us about 29%. DaVita and Fresenius combined own about 70% of the market. So that gives about 29% of the market left over to acquire. That's not a whole lot of growth domestically anymore. So we believe that they're definitely going to focus more on expansion internationally, because that's where they're going to start seeing those growth numbers.
And also, it takes about $2 million to open a new dialysis center. So their leverage is going to be, as they take over a portion domestically, they're going to not have to acquire as many dialysis centers, but patients are going to continue to increase. So it'll be less CapEx on their part and more patients. So it'll be how you utilized their current dialysis centers.
You guys have a pretty strong buy recommendation,
Upside?
yes. What are you seeing that the market is currently missing in your analysis?
I think their behavior is kind of doing a big number on the market right now. I mean, it's been what?
It's time.
Sorry. Thank you.
Are you guys all wearing the same?
Yeah, we're all wearing yellow ties.
I wanted to ask, but we ran out of time.
Yeah, very much.
Yeah.
Great job.
Okay. Okay. Their tie, yes.
We asked her to.
I'm not wearing a tie. I'm wearing a necklace.
So that was the University of Colorado Denver. The next team to present, the University of Colorado Boulder.
See all look official? You look like really stiff financial guys, you're gonna like trash. You can do both. Let's do it. You know, I find that the flashes work better when you turn them on. Perfect. 1, 2, and perfect. Man, you all look 20 years younger than you do in person. We have software. Thank you, Jim.
You're trying to improve the factors in their efficacy. I don't know why there's a or yeah. We can said that they're letting their factors. The target on
Lighting perspective. Great lighting here. This is perfect. Actually, you were.
You can see it. That's really They didn't want to sit in there.
Oh man, it was great. There's just we saw us up there initially. We were number one, and we were just like, yes, get it done. It's a change that you take.
We've only like a couple of changes, I think. Yeah. The state law was the same.
Yeah. No, it was good. It was I think we did really well.
Good times.
Oh, like it. Like it.
Oh, sorry. Well, since you're yeah, I didn't want to steer some of the things the audio was off again. So,
Hey, how many hits on YouTube?
Judges ready for the next scene? Right, so please welcome the next team, University of Colorado Boulder.
Good evening. We are the University of Colorado Boulder research team. My name is Lauren Weidenfeller, and I'm a sophomore studying finance and accounting.
I'm Peter Zeal, and I'm a senior studying finance and accounting.
My name is Hank Hammond, and I'm a senior studying finance.
And I'm Austin Kavanaugh. I'm a sophomore studying finance and accounting.
We're excited to speak to you tonight about DaVita and the research we put together in valuing the company. We'll start with a company overview and then move into what makes DaVita's competitive positioning unique. Then we'll move into financial analysis and valuation, and finally weigh that against potential risks for a final recommendation.
So for our recommendation, we are issuing a buy rating at a price target of $86, leading to an implied return of 47%. Now, this is largely driven by demographic factors in the kidney care business, such as an aging population in the U.S. market, which will lead to a larger population for DaVita to draw, as well as an operational and financial turnaround in the healthcare partners segment. And finally, the opportunity for DaVita to become a global player in the kidney care market is forecasted into our recommendation.
So DaVita possesses two main business segments, kidney care and healthcare partners. Kidney care is the dialysis segment. It represents 35% of the U.S. dialysis market, possesses strong inorganic and organic growth, and is well known for its high quality of care amongst its competitors. It also represents 64% of DaVita's revenue. Healthcare Partners is the managed care segment and is a network of physicians acquired in 2012. It expands into an average of 1 to 2 markets per year, and it represents 27% of DaVita's revenue.
One competitive advantage that we identified as unique to DaVita is that in addition to these two segments that we just mentioned, they're the only dialysis center that offers a third segment, and that's their ancillary services, such as research. Another competitive advantage that we identified was their strength in acquisitions. DaVita relies heavily on inorganic growth, and we've seen success through acquisitions such as Healthcare Partners. A third competitive advantage that we see is market share. DaVita and their main competitor, Fresenius, make up over 70% of the dialysis market, creating high barriers to entry and a competitive advantage. From a Porter's Five Forces standpoint, we identified intensity of competitive rivalry as low, and this is because Fresenius and DaVita essentially have a duopoly in the dialysis market. That also plays into threat of new entrants. Because of the large market shares of these two companies, it would be very hard for another company to enter in and compete with those two. There are substitute products we also identified as low, and that's because from a dialysis perspective, there's only one treatment for end-stage renal disease other than dialysis, and that's waiting 3 to 5 years for a kidney transplant. Supplier power, we believe, is high.
And that's because Amgen is the producer of a drug called Epigen, which is used for dialysis. And Amgen and DaVita have a contract that runs through 2018, meaning that certain prices are locked and therefore reimbursement rates are not that volatile. Finally, firepower we also identified as high, and this is because the government is a large part of the clientele of DaVita, and they have a lot of bargaining power over reimbursement rates through Medicare and Medicaid.
So for competitor analysis, we talked a little bit about the duopoly in kidney care with DaVita and Fresenius covering over 70% of the U.S. market share. But in the healthcare partner segment, which performs managed care in the U.S. market, this is a little bit more fragmented market space filled with physician groups, hospitals, as well as other payer groups in the market. And while this opens up more opportunity for integrated growth strategies through physicians, it also makes it more competitive space for healthcare partners to be successful.
So some of the uncertainties surrounding DaVita's success really center on the variability of reimbursement rates from the government, as Medicare does represent a large portion of DaVita's payers. These reimbursement rates are subject to political tides, and the government payment rate can really affect DaVita's profitability. Demand drivers include the life-saving nature of dialysis, as well as the duopolistic market dynamic and the lack of substitute treatments. Historically, non-acquired growth has averaged around 5%.
So getting into some of the income statement items here, we do see top line revenue growth from all three segments. That's kidney care, HCP, and then the ancillary services and strategic initiatives, which includes DaVita's international dialysis operations. And we see that revenue growing in the 6 to 7% neighborhood for the next 5 years. And so we do see margin compression in the near term, and that's driven by kidney care's large portion of revenue and net income currently. And that's driven by, in 2014, Medicare considered a 9% cut to the reimbursement rate. Instead of instituting that in 2014, it was spread out over 3 years. So right now, the reimbursement rate isn't keeping up with some of the costs, so there is margin compression there. But in 2017 and beyond, we see kidney care getting margin expansion from reimbursement rates keeping up with costs. Additionally, HCP, the nature of the business, it becomes more efficient with time. As patients spend more time on HCP, they're able to take advantage of preventative care instead of waiting for acute and emergent care, which is more expensive. So that helps with capitated payments when there's lower variable costs. And then lastly, strategic initiatives. This includes international dialysis as our main driver. We see this has been operating at a loss recently, but we do see it becoming less of a loss over the next few years, breaking even in 2019 and then being profitable in 2020, perhaps with a major acquisition there that we modeled into some of the scenarios in our model.
One important note for investors is to look at the capital structure of DaVita. DaVita has about $9 billion in debt and holds about $5 billion of book value of equity. This worries certain investors because of the large amount of debt that DaVita has. However, from an interest coverage ratio perspective, their interest coverage ratio is 4.5 times, meaning that they shouldn't have a problem paying back the interest on their debt anytime soon. That debt is mostly comprised of a mix of senior notes and term loans, almost all of which are due past 2020. From an equity perspective, they are outpacing their main competitor, Fresenius, by about 3.5% when looking at return on equity. And we see equity as a strong point moving forward because there's $650 million of approved share repurchases that DaVita still has, and we expect them to continue to buy back shares, meaning that they're valuing their own stock as undervalued.
So to arrive at our final DCF calculation, we first had to calculate the weighted average cost of capital. We derived the cost of equity using the CAPM formula and statistics derived from Bloomberg. The cost of debt was calculated using yield to maturities, also from Bloomberg. Our final weighted average cost of capital was 6.2%.
So one of our valuation methodologies was a PE multiple, and this takes into consideration DaVita's trading price to earnings multiple since 2013. We did that because HCP, the acquisition of HCP in 2012 kind of changes the dynamic of the business. So in 2013 on, we're considering the business as it is now. So the 3-year average there is 20.4 times. We applied 20 times to our estimated earnings per share for 2016 of $4.26. And that results in an $85 price target in the base case scenarios. We did have 9 different scenarios that I'll touch on after Hank talks about our second methodology, which is the DCF.
So along with this PE multiple valuation, we also use the discounted cash flow methodology in order to calculate the intrinsic value of the firm. And we calculated free cash flow to the firm and used an exit EBITDA multiple of 9.5 times to arrive at a price target of $87 per share, which would be equally weighted with the PE multiple valuation.
So as I mentioned, we did have 9 different scenarios for our valuation, which took into consideration various business and then macro considerations. So the macro considerations would change things such as the payer mix for kidney care between commercial and government payers, as well as the payer mix for HCP, and then business considerations are items such as the actual reimbursement rate on kidney care and some of the margins. And so we did like a normal distribution, applying with the base getting the highest weighting, and then some of the less likely scenarios in our view, the bear and the bull getting much lower weightings. And that resulted in our weighted average price target of $86, which does imply a 27% return.
So as with any investment, DaVita does come up with risks. These include political and legislative risks, as reimbursement rates, which are key to DaVita's profitability, are subject to political scrutiny and legislative action. Litigation risk is also a concern as DaVita has faced legal and settlement issues in the past. Supply and labor cost risk represents the supplier power held by Amgen, as well as Medicare as one of DaVita's major payers. The interest rate risk also exists due to DaVita's large holding of debt in a rising rate environment. And then finally, execution risk is also important because much of our thesis does hinge on future success and strategic acquisitions internationally and otherwise.
So in conclusion, we do issue the buy recommendation with a 27% upside at $86 per share. And we'd be remiss if we didn't mention some of the risks throughout the presentation, but overall we believe that the merits of DaVita, such as favorable demographic trends in the kidney care area, as well as turnarounds in HCP and opportunity for international expansion, provides a very optimistic view at the company, giving us all the price target.
So question on your international expansion, where does the company stand now? And what is the game plan for making that a successful venture over the next 3 to 5 years? Is it through acquisition? Are they targeting specific regions of the world? What do you see happening?
Sure. So right now they're in 10 countries, primarily Colombia, Malaysia, and Germany. And they have 7,000 patients roughly for the 2014 10K. We do see that in our base cases growing about to about 15,000 by 2020. And this kind of considers some of what Kemp Theory and DaVita has said with regards to international dialysis becoming and strategic initiatives becoming profitable in the medium term, but haven't given too much details into that. I did mention a major acquisition in one of the previous slides, and that was built into our bull business case. And that's the $2.5 billion acquisition of DaVita, which is a large and major player right now. They've been in talks with some private equity firms and refinanced debt, which in our view means they're positioning themselves for a potential sale. And we came to $2.5 billion based on some recent deals with Gambro and some other international and domestic deals. And that would result in a substantial increase in about 30,000 dialysis patients when we forecasted DaVita's business. So we do see a lot of opportunity there, though we did weight the major acquisition much lower because of the uncertainty there.
Thank you.
It's been a struggle for the company to really expand HCP and do it, get that model in more states. As you looked at your revenue growth for HCP, how did you consider that? I mean, are we going too fast on that side of the business?
Right, I think so. We have seen some concerns with HCP over the last couple of years. A couple of bad deals done in Nevada and Arizona, but we are very optimistic about healthcare partners, especially with Kemp Theory taking the reins there, largely with inorganic growth. So they're expanding into these new markets, and they're taking their brand in with being the leading provider of quality care, and they're going to be able to target patient bases that are more well aligned in a capitated model than they were able to do in the past with some of the scam payers in Nevada and other issues like that. So we're optimistic about HCP with a top line revenue growth about 10% year over year, due largely to acquisitions of patients such as the Everett clinics as well as Colorado Springs Health Partners. So we're again looking forward to kind of an operational and financial turnaround in healthcare partners.
I think one point on that, kind of referencing actually Kent Theory from 2005 in the letter to the shareholders after the major Gamber acquisition. He equated a large acquisition, and HCP was a larger acquisition than Gambro, to being a marathon. Obviously, there's going to be some problems trying to integrate two major companies, this even more so because it's not just a dialysis company, it's a managed care company, really changing the business model as a whole. So we looked on that, we saw the way that DaVita and Kent Theory were able to turn DaVita into such a successful company, and we think he's just as capable of doing that with HCP.
Talk a little bit about the factors that you went into the bull and bear case for the macro and the business in particular. I think we saw just on that slide, just that you did the analysis. For example, on the macro side, what economic data were you looking at?
So the macro was more in tune with a demographic projection we did primarily on the kidney care side, and that took the prevalence rates of ESRD and kind of shocked them a little bit. So we took out bins based on the Census Bureau forecast and then some historical data for prevalence of ESRD. And right now that's roughly growing at about 4% per year. And then we shocked that by plus or minus, I believe it was 1%, which is kind of the standard deviation of growth we've seen in recent times. And then we also shocked the payer mix. Right now, 90% of dialysis treatments go to government payers and 10% commercial, which is where a much larger amount of the profit and revenue per treatment comes from. We're shocking essentially the payer mix. So government was increasing over time in the base cases, but then in the bull case for DaVita, that would come down. So there's more commercial payers, so there's better margins, and then vice versa for the bull bear case. It would be a deterioration for the mix, and that would decrease margins. And then in the business case, the main shock was to the reimbursement rate for kidney care as well. And right now we took, Medicare has a forecast for the basket that the dialysis reimbursement gets adjusted at. It's flat in the near term due to that 2014 cut being spread out over a few years. But we took that increase of about 1.5% per year and again shocked that by 50 basis points either way, which impacts the top line.
You just you put a lot of weight on your P multiple. You have a slide on that. Did you look at how that multiple compares to competitors, namely their primary competitor SCS? And maybe is it treated at is DaVita treated at a premium or discount to their competitor?
Yes, so I think generally, as far as PE multiple goes, currently in the market, DaVita does trade at slightly higher than Fresenius right now. I think they're at 29 times, and then Fresenius is around 24 times PE. And as far as this PE multiple goes, we looked at it as a conservative way to do the valuation for at least this part of the valuation.
So as a follow-up, does DaVita deserve to trade at a higher multiple than Fresenius?
So DaVita does have more leverage than Fresenius, and that is what's, in our view, contributed to the 3.5% ROE outpacing of Fresenius because they can use leverage in the capital structure and get the benefits of that. So I think that the PE multiple being at a premium makes sense. I guess in some sense that represents downside as well in a bear case because of the fact that that leverage is a problem in terms of interest coverage and whatnot if the business does go south. But I think that for the company is managed well and has been able to manage the debt load, and that is what's contributed to being at a premium to Fresenius.
And I think the other thing with the PE is it's forward-looking, and so from the way we modeled it out, when we're looking into the future, we do believe that it should be trading at a premium because of the operational efficiencies and the acquisition acumen that the company has done as compared to their competitors.
Somewhere in there you had a pro forma statement, and I want to better understand why you believe in 2017 earnings rather margin pressures will reverse. Is that your opinion, or is that guidance you get from management? How did you arrive at 2017 being the inflection point?
Yeah, so that's when we view, primarily goes back to the rate pressure from Medicare. And so that's where the 2014 got spread out over 3 years. So the reimbursement rate isn't keeping up with what we see as the cost increases. So in 2017 is when we show more normalcy in the reimbursement rate increases, which will keep up with the variable costs. And then a large reason that DaVita's had success is this acquisition that has consolidated the industry, utilized economies of scale when there is such pressure from Medicare. So again, so the SG&A expenses like that are relatively fixed and can be spread out over more centers. That DaVita starts to realize the benefits of that as well as the increases in the revenue.
Recently, DaVita has grown less than 4% on the kidney care side. What's attributing to that in the research that you did?
Are you talking about the non-acquired growth rate?
Mm-hmm.
I think so. That's just one data point. I think it's in theory. Theory didn't give much kind of insight into that on the investor presentation for the third quarter. I think that we still think that there's potential for non-acquired growth, just given DaVita having some of the highest quality of care, a good reputation. We call it Western Nephrology, which is a local nephrology clinic. They do have a relationship with DaVita and American Renal Associates, so it's a well-respected dialysis provider that is going to get referrals from the nephrologists that believe in it. So I think it is, I suppose, troubling that it is down from where it's been historically, and we do show 4.5% non-acquired growth rate going into the future. And I think that really just hinges on that being kind of an outlier, and DaVita still utilizing the fact that it provides great care and it has had high non-acquired growth in the past.
I think demographics do play a little bit of a role in that as well. Going forward, we do see a slight shift in demographics to an older population, which would be statistically more likely for more kidney dialysis. Okay, sorry.
Thank you very much.
Thank you.
Thank you.
We are on the wrong side.
Thank you very much.
Thank you.
Thank you.
So that was the team from University of Colorado Boulder, and then the next and the last team to present will be Colorado State University.
Oh, yeah.
Oh, yeah, sorry.
Oh, that's good.
That's like right there.
She asked.
It's all, it's so
and she was here. I know.
You definitely have better memory than
Resolution of the growers now is getting so high. They still have
Yeah, it is. Yes. Are you ready?
You do that after. You do that after.
Everyone started on the good.
Yeah. Roll with a little Okay. Sounds fun.
So the last team to present is Colorado State University. Please welcome CSU.
Good evening. Thank you for having us. My name is Dan Melton. With me, I have Aaron Avery, Justin Barella, and Stefan Skoglund. And this is our analysis on DaVita Healthcare Partners. Now, DaVita started off as DaVita Kidney Care and was founded in 1999. Since then, they've grown to become the industry standard for quality of care and dialysis treatment. DaVita and their main competitor, Fresenius, own approximately 70% of the overall U.S. dialysis market, with each having roughly 35% share. Now, due to this, DaVita sought to diversify its revenue streams and get into the managed care segment of the healthcare industry. In 2012, they acquired healthcare partners and began to diversify their revenues. Currently DaVita is trading around a 52-week low. So with our 1-year target price of $81.22, we see an opportunity to capture about 22% return on investment. This target price has been derived from an overall 7% growth in overall revenue. Now, DaVita does have international operations in 11 countries. However, the majority of its revenues do come from the United States dialysis segment, which accounts for about 62% of overall revenues. The managed care segment, as we call it from HCP side of things, accounts for 28%, with ancillary services being DaVita's subsidiaries such as DaVita RX, the clinical research, and their international operations accounting for about 9.7%. Now, we assume that about 5.5% of that 7% growth is going to come organically, primarily driven by the rapidly expanding ESRD, or end-stage renal disease population. Over the last 20 years, the end-stage renal population has grown at a 4% compound annual growth rate. However, recent health trends, including the aging population, the increased prevalence of diabetes, obesity, and hypertension in the United States, suggests that that number is going to increase in later years. Now, in 1972, the government added a provision to Medicare, which allowed ESRD patients to receive Medicare benefits no later than 33 months after they begin dialysis treatment. This 30-month transitional period is the period it takes from a private payer to transition into Medicare being the primary payer on those reimbursement policies. Currently, DaVita has 90% of their dialysis revenue comes from the government payer. And the current reimbursement rate is about $1 below DaVita's cost of revenue on dialysis, which leads to an overall net loss, which leaves the 10% of privately insured to account for 110 to 115% of DaVita's dialysis profits. Now I'm going to pass it over to Stefan, who's going to continue the industry analysis and go a little bit into the financial positioning.
Thanks, Dan. So as you can see here, the threat of new entrants is very low. Any new entrants are usually just small private firms who may be able to compete on the local level, but it's very unlikely that they'll have a big effect on DaVita's bottom line. There's also a small bargaining power coming from their suppliers. One of their main suppliers is Amgen for their drug of EPO. DaVita is currently in a contract with Amgen until 2018. While in the past, DaVita was more at the mercy of Amgen for the price they would pay for this drug. Once their contract expires with Amgen, they will no longer have a patent on EPO, and we expect more biosimilars to be available on the market. There's close to no threat of substitutes to DaVita, as if your kidneys are failing, you either have to receive dialysis or get a transplant. Right now, the average wait time for a kidney transplant in the US is around 3 to 5 years, depending on your blood type. There's little competition within the industry, as there's only one major competitor for Zinnius, and while they may compete for acquisition targets, we think it's very unlikely that one of them will be able to obtain a significantly higher market share than the other one. The biggest threat to DaVita we see coming from the bargaining power of their customers, as DaVita is unable to turn away any government payers, and they lose money on almost every single one of these patients that they treat. Therefore, private payers are needed to maintain the profitability of their entire group. Now going on to inorganic growth, we've assumed that DaVita will grow inorganically at a rate of 1.5%. This is based entirely off of historical acquisitions. In the past, DaVita's had a very steady number of acquisitions, ranging from 3 to 5 within the last few years. While we do realize that it's unlikely for DaVita to spend as much as they did in 2012 on HCP within the next year, that is why this year was treated as an outlier when we calculated our inorganic growth. We expect inorganic growth for DaVita to come mostly on their managed care side of business now, as they look to expand into new markets, with most of their organic growth coming from kidney dialysis, with the increase in ESRD rates and growing aging population. Now to continue on to DaVita's debt structure, DaVita's in a very financially sound position, with 38% of their balance sheet being debt and an S&P rating of BB. DaVita currently has a very small amount of short-term debt, with most of their debt coming to maturity around 2025. DaVita's interest expense is currently covered by EBITDA by almost 6 times, and because of this, we believe DaVita could actually take on more debt to acquire any viable businesses that they see fit. Now I'm going to hand it over to Justin, and he's going to go into our valuation.
Thanks, Stefan. We derived our 1-year target price using a weighted optimals model. This model used
This model projected future price and its accuracy by taking 6 years of financial data and analyzing 1-year forward-looking multiples and comparing those prices to the actual multiples occurred, the actual prices that occurred. We then took those prices and ran a least squared regression in order to find the weight of each multiple in order to determine our 1-year target price. We also used a 1-year forward-looking multiple based on the revenue segments of DaVita, weighted at 65% of dialysis and 35% of the industry average multiples for these segments of managed care and ancillary services. As you can see, Fresenius and DaVita occupy 70% of the U.S. dialysis market, and that is why Fresenius and DaVita's multiples were weighted so heavily in our 1-year forward-looking multiple. In addition, it's worth noting that historically, DaVita has underperformed with Fresenius with 2 of our heaviest weighted multiples, price to sales and price to earnings. This can be partially attributed to the difference in product mix because Fresenius has more exposure to international dialysis as well as the manufacturing of dialysis equipment. A DCF was run and used as a check figure for our target price, but it was not used as our primary model. This is due to its inherent characteristics of overestimating assumptions used in the performance statements and growth rates as it's grown into perpetuity, and its misalignment with our 1-year stated target price. In addition, our assumptions for our DCF included a discount rate equal to DaVita's weighted average cost of capital of 6.27%, a 2016 pro formas that we created, and a 7% growth rate, tapering to 2% terminal rate over the next 5 years. Because DaVita has experienced a 14.7% compounded annual growth rate over the past 5 years, it is likely to outperform its 2% growth rate terminally, so we decided that a target price of $87.51 would be used as a check figure instead of used as our main target price in our analysis. I'll now turn it over to Aaron Avery. We'll go over our Monte Carlo simulation and risk analysis.
Thanks, Justin. So as you can see on the screen here, we have constructed a Monte Carlo simulation using the parameters of the random walk theory for a daily change in DaVita's target price, simply because that's the most expected change of 0 any given day. The other parameter, we took the 2-year annual historical volatility and created a daily volatility from that, creating bounds at which the price can change. And we ran a simulation out to 1 year with 1,000 iterations to produce this Monte Carlo simulation. Our target price of 81.22 is in the 90th percentile, meaning that it is high, but keep in mind the Monte Carlo simulation is not fundamental analysis, it's purely statistical, which is why we created a buy recommendation for anything in excess of 1 standard deviation from the current price of roughly $66.50, a sell recommendation for anything to the left of the current price of $66.50. The reason why is that that's 1 standard deviation, and that's roughly about the annual historical volatility of 15% that we see going forward with DaVita. Getting into the risk analysis, again, kind of summing up the presentation, some of the strengths we see with DaVita are its large market share and its EBITDA to interest coverage ratio of about 6 times. Weaknesses of DaVita include the CMS reimbursement rate and the fact that 10% of all payers account for relatively 100% of DaVita's profits. Opportunities for DaVita include the ESRD population growing at an exponential rate, potentially exponential rate, but a high rate over the next couple of years, and the renegotiation of the EPO contract with Amgen that expires in 2018. Threats for DaVita include its main competitor, Fresenius, and the Affordable Care Act and any further government regulation that we see. The right side of the screen shows a risk matrix. I want to highlight SR3 and GR1. SR3 is international risk. With DaVita going international, we do expect to see some foreign economy risk and new government regulation. GR1 is the payer risk. As I mentioned earlier, 10% of patients provide 100% of profits for the firm. Once again, we'd like to reiterate a buy with our target price of $81.22, providing roughly 22% upside over the next year. This is derived from our multiples analysis, as mentioned earlier, and DCF is used as a check figure. Thank you, and we'll now open it up to questions.
So the certainly the reimbursement rate's pretty important since it provides most of the profits.
Right.
What how was that determined, and what's kind of the long-term nature of that?
What do you mean by how often is that determined?
How often does the government reset the reimbursement rates?
Do you mind if I take that?
Please do.
So, to the best of my understanding, the CMS reimbursement rate is calculated using their PPS system, which adjusts for inflation. Now, as of the past, the DaVita was especially concerned because it was adjusting at a negative rate about -1%. Since then, it's been adjusted to account for inflation in between 30 basis points and 50 basis points over the next few years. Now that is strictly adjusted for inflation. So whether or not Medicare will receive additional funding and change the reimbursement rate would have to be figured out within legislation in Congress.
You used the growth rate of 7% for revenue, and you broke it out, organic, non-organic. Can you talk a little bit about what's going on with earnings and what earnings have looked like over the last handful of years and where you see earnings going forward?
Okay, yeah, we can grab a. We don't need that. So earnings have been steadily increasing with the exception of the trailing 12 month due to that $500 million legal settlement that occurred in the last period. So overall, our earnings growth are in line with the exception of the acquisition of HCP. So we took basically DaVita as a new business after 2012 and calculated its growth rate less capital expenditures on new acquisitions. To see where the firm has been growing historically. And we came in between about 4.5% to about 5.5%. So with our pro formas, we actually, let's see if we have our income statement. So with our income statement, we actually ran a worst, best, and expected case scenario. Ran that through our optimized model 3 different times. So we actually produced a range from about $79 to $83 a share. So we kind of captured the high and low end of overall earnings growth throughout the year. Did that answer your question?
Just talking a little bit more about growth. So on the kidney care side, how do you see Fresenius and Fresenius kidney care business and DaVita's? Is there market share being taken in your model over time by DaVita? Are they growing at the same pace? Like, how do you see the two companies?
Go ahead. Well, I was gonna, in the U.S., we see them mostly growing around the same pace as far as kidney dialysis goes. They're both well across the entire United States. The main difference that I see is Fresenius being able to capture a lot more of the international market due to the fact that they receive almost around 30% of their revenues come from overseas. So while increasing ESRD rates and increasing diabetes continues to expand internationally, Fresenius will be able to capture more of that market than DaVita will, as they're not expanded as well internationally.
So
if you want to expand.
We do see upside with international expansion. The problem is only 1% of DaVita's revenues really come from international dialysis right now. So Fresenius is already kind of stable in the international market, as Stefan was saying. So it's going to be hard for DaVita to break into that. But domestically, we do see them growing at roughly the same rate. We don't really see too much of a change in market share. Thank you.
When talking about the distribution that you used for the Monte Carlo model, looked fairly standard distribution there. Did you consider other distributions, some slightly fatter tails, or highlighting a little more volatility?
Yeah, we actually did. The reason why this is a standard distribution is because it uses the random walk theory. So it assumes that the price change in any given day is going to average 0. Just because we didn't want to put in a growth factor, even though DaVita has been historically growing throughout time. We did look at a growth model, but we figured that this was the best way to capture where our target price fell from a completely statistical analysis. It was mostly used as a validation for our pricing model rather than an actual model to calculate price. If that answers your question.
Definitely one of the efficient markets.
Correct.
You slide on their capital structure. You said that they could take on additional debt. How much, in ballpark, nothing specific, how much additional debt do you think they could take on for an acquisition to kind of maintain their borrowing rates?
Well, I can start with that. We actually think they could almost double the amount of debt they take on. They're actually currently borrowing at fixed rates. Right. So,
well, all their bond issuances are fixed rate. Their loans are issued at LIBOR plus around 250 basis points, I believe. But since they're covered so well by EBITDA, the only question they really need to ask, we think, is if they're willing to lose their BB rating and go further into junk bond territory. But besides that, we think that their earnings and their revenue is very stable, so they could potentially lever up more, make another big acquisition like we saw in 2012 if they feel like that's needed.
And just to add on that, relative to the managed care industry, they're actually not too terribly levered in comparison to some of the larger players in the healthcare industry.
If their lending facilities are keyed off LIBOR, any thoughts on the potential for higher rates and what that may mean to their capital structure?
Well, so none of their debt issuances, all the ones that you see out here in 2025, none of those are floating rate, which we see as a big advantage. Their loans, those are mostly coming due around 2019. And while that isn't, that's not super short term, we don't think that there's a huge range for them to see any negative potential there, as it's not a huge amount. And we're not sure if rates will continue to rise. That's still pretty unclear, and for us to try to predict any huge increases in interest rates would just throw the valuation off. Would it be as accurate as to date as it is?
Was your question more concerning new debt, or did you mean with the floating rate with the existing? Okay.
On the healthcare partner side, it's been a little bit challenging to expand the business. As you think about your buy rating, how much risk is there? Is the company growing too fast on that side of the house?
Well, I don't think the revenue segment is large enough to really be able to worry about it too much. We also have that as a risk in our risk analysis. But I think that based on the way that DaVita can carry itself with its dialysis revenues, it's able to take a little bit more risky moves. Is that kind of what you're asking?
We see it as a diversification play rather than just being solely involved in ESRD and dialysis. It actually serves to kind of break up the revenue stream and source from other places. So actually we see it as a positive, and the growth we think is healthy.
And the main risk we see from managed care is more when they start going into different states with different laws and stuff. If they're not familiar with them, could be fines, could be just different legal issues that they're not aware of. So the main risk we see there is as they try to expand into more states, but at the same time, that'll make them more diversified geographically, which will benefit from.
And to answer your question a little more directly, with any acquisition, there is going to be risks, especially as you're moving into a segment that you may not be as your core competency. But we think that no acquisition is going to exceed the size of HCP in the coming years. And I think that's been really, really well integrated. Obviously, the operating margins are a little bit slimmer on the managed care side of HCP, and we've seen a decline in operating margins as we've post 2012 as we've diversified away from the dialysis only segment. But we think overall, exposing yourself and being more diversified takes away from risks.
What would cause you to change your outlook? So right now you're at a buy recommendation. What would it take for a hold or even sell?
I think the big one would be any downturn in the economy, which I would see having a big effect on their reimbursement rate and possibly their patient structure. If there's a down in the economy, there's going to be less tax revenue for them, so the reimbursements are going to be lower. Businesses start offering more restrictive commercial policies, so now private payers aren't making up as high a percentage of profit, and possibly maybe not even adding to their profit. So any sudden economic downturn where reimbursement rates aren't adjusted quick enough could see a pretty big downfall for people.
We would also have to see something change within their financials. It's a product that is in high demand and there's no alternative to it. So the company is going to continue to grow, but we're going to need to see something really interesting in the year of financial statements in order to say we would change our price.
How's your buy rating compared to Wall Street? What's Wall Street's view on this?
It's actually slightly higher. At least when we were looking on Bloomberg, I think the average was probably around $89.
Right, it's fine.
Thank you.
Thank you. Yes, very good.
So that was the Colorado State University, and right now we're going to take a break to calculate the scores. And if all the teams can actually take photographs and the group photos, if you turn left down the corridor, there's a photo set awaits for you. So take a group photos, and in half an hour, about we will meet to announce the winning team.
I don't know. Now we
Yeah.
It's like the answer is y'all are totally wrong.
It's like
that is the intimidating part. Say everything with confidence, but you better be right with like this right here. It's tough, right?
Hopefully I can. Yeah, I'm
This was a lot easier than I mean, to do it right, it's a lot harder.
I think we're ready to get started. So first of all, I would like to congratulate all the teams for making this far and doing the research and having a written report and presentation and all the experience you gained through participating in the research challenge. I think you all, in a way, win the prize for being a finalist in the research challenge. And the team that will advance, they just have an additional bonus of being able to present the same report at the Americas final and represent CFA Study Colorado and Colorado State at the next level of the competitions. But hopefully you really enjoyed the process. Maybe you didn't, which is also a good thing. This way, you know, you have to change your major or you have a different, a different career. So it's very, very valuable because 5 months actually will prevent you from making a life mistake.
Be here all night.
But the scores are not reflection of that, so don't take it against the judges or the graders. And you should also say thank you to all your mentors and industry advisor for their help in mentoring you. And I would also say that you can use the research that you have written to post on the LinkedIn as a sample of your work. If you're applying for jobs, you can bring a sample of the equity research you have done. It will demonstrate the high quality of work that you put in, and hopefully also you also made new friends. Some teams from the prior years, they stayed together after the research challenge. They really enjoy the equity research, so they signed up for the CFA exams, and they studied for the CFA exams together, and they passed level 1, 2, and hopefully level 3. And sometimes, well, you also develop a network that you can refer to when you're looking for a job or just a career or educational advice. So hopefully that has been a pleasant and useful experience for you. And you can also help the younger students, younger generation for the next year to enroll, and you can trick them to say how great it is and that it's not as much work as you thought. So on this note, I will read the list of schools based on the rankings, starting from the 6th place and all the way to the champion. So the 6th place goes to University of Northern Colorado, UNC. The 5th place goes to University of Colorado, Denver. The 4th place goes to University of Denver, DU. The 3rd place goes to Metropolitan State University of Denver, Metro. Now there are only 2 schools left. University of Colorado Boulder and CSU. And the 2nd place goes to University of Colorado Boulder, and the champion team, you should come to the stage. We have award trophies for you. And for the advisor, you be present.
Thank you very much.
Congratulations.
Good job. Thank you.
That's right. You also deserve a
Thanks so much. So thanks.
Yeah.
Great job.
So there's a trophy for
Brian.
Yeah,
I got it.
Brian.
Yep.
Yeah.
Yep.
So we'd like to get a group photo with you guys with your trophies down the hall. Another location. Okay.
And now we have an extra.
All right.
Thanks so much. Thanks so much. Appreciate your questions. Thank you very much. Thank you very much. Great question, guys. I appreciate it.
Oh, and then everybody who participated, you can receive the certificate. So make sure you see Bob for certificates.
I could say that myself.